Hi guys, this is Tim speaking from Skyrocket, the strategy channel. So today I'm going to present a new framework for you guys to see. It is the a16z investment decision framework in a time of change. This framework was drafted by Alex Rampell, who's a general partner at a16z. He had created this framework during the COVID-19 epidemic, wanting to analyze how an investor could change his or her mindset when faced to new investment decisions when things change really rapidly and suddenly. So what I'll show here is first what Alex Rampell did, and second, how I built a universal template out of this. So um, um, let's see what actually Alex Rampell did. So we have here first a the matrix in itself. So you have two accesses: one, nature of the opportunity, and second, impact of the opportunity, the investment opportunity. And there you have two different outcomes. So first, the impact of the opportunity can be positive or negative, and the nature of the opportunity can be ephemeral or structural. And based on this, so if we look at the theory and right here, you have four different possibilities. So structurally negative, structurally positive, ephemerally negative, ephemerally positive. And what Alex Rampell did is plot, well, he didn't actually plot them exactly. He categorized a certain number of investment opportunities. And I decided to make this a little bit more fine-tuned, as you can see here. And his conclusion is that only structurally positive or ephemerally negative have the best investment opportunities. So basically these and these. And why? First, for the structurally positive, because they are better by a factor of 10 or a tenth of the previous cost. So there's improvement in cost of scale. And so there's usually no way back when these technologies are adopted, even in a time of change. Typically take remote work. The company Wimi I work for is a good example. And for ephemerally negative changes, this is different. It's the fact that the demand is halted suddenly, typically restaurants or travel. And this creates opportunities when things come back to normal. And so actors who have smartly invested will have an opportunity to take market shares at this point. So these are the both good ones. The others are not good simply because structurally negative ones where you're betting on something which will tend to disappear, and ephemerally positive, or it's things that have proved some impact in the given context, but who are not going to last for long. So you have to be in certain models where you can invest and get an ROI very quickly. So it's not usually where investors would tend to advise to put your money. So given the success of what Alex Rampell did here, I decided to create basically a generic matrix, which you can see here. I even created a color code for different industries. And so this enables any investor in a time of change to plot the different opportunities he or her has, and then decide where to invest first, and especially in these two categories here. What you have behind this is a very simple Excel model where you rank the nature of the opportunity and the impact opportunity from 0 to 1. You have the basis for the score here. You put the opportunity name, the industry in which they are. It automatically tells you in which category it is. And then you move around different things to make it look cool. Change your logos, different parameters that are really pertinent in your case. And that's it. So this slide is very useful to suggest, for instance, to board investors where the money should be put this year. It's a great one to include in your slide deck, so make good use of it. If you have questions on it, feel free to reach out to me. I'd be happy to help. And of course, Alex Rampell is probably an even better reference. So thank you, Alex. Thank you, a16z, for this framework. And I hope the generic version can be useful for many of you. Cheers. Bye-bye.